since you like analogies, Nick Timmeros had a really good one in the journal the other day, which is like tapping a bottle of ketchup, and at first nothing comes out, and all of a sudden, like it just, your meal is ruined by a bucket of ketchup.
That's a great
Isn't that
example.
perfect? And
I'm
so
going to
that
steal
thing,
that.
yeah, so that's a really good one, and that's kind of where we are. But you don't know how much is going to spill when, right? So I think to your point, yeah, if you add that lagged effect to the existing stress, that could be a very, perilous combination. And
And
I think this is just the first of many episodes. I hate to be like, I'm not fear mongering, but this kind of crisis doesn't just go away in a flash, right?
welcome to Wealthion. I'm Wealthion founder Adam Taggart. The Fed is really feeling the heat these days. While inflation is starting to come down, it's still far too high, with February CPI coming in this week at 6.0%. Similarly, the latest government data on the jobs market shows it's still far hotter than the Fed wants. With data like this, the Fed can't justify a pivot. Yet at the same time, the swift and sharp increase in interest rates the Fed has engineered is now starting to result in casualties, such as the banking failures that have happened over the past week. A big enough breakage in the system could force the Fed to change course. So how is the Fed navigating the increasingly tight spot it's in? To find out, we're fortunate to be joined today by respected journalist Pedro de Costa. Pedro has spent the past 20 years covering central bank policy for publications such as Reuters, the Wall Street Journal, and now M&I Market News. Pedro, thanks so much for joining us today.
Thanks so much for having me, Adam. It's my pleasure.
All right. Well, look, I appreciate you joining us on what clearly is got to be a super busy week for guys like you in terms of what you cover for the media. Let me just start this interview out with a very general question. I'm going to tweak a little bit for you, given your area of focus. What's your current assessment of the U.S. economy and the banking system?
So on the economy side, we are already in a very kind of puzzling moment for the economy, because you had a Fed that was hitting the brakes very hard, tightening very aggressively, and people were kind of befuddled by why there had been very little perceptible effect on the labor market, for instance, why job growth is still roaring at 300,000 to 500,000 jobs a month. The unemployment rate is still near 50-year lows. At the same time, there were signs of fraying. Growth is slowing and consumer spending is slowing a little bit, but there was certainly no sign of imminent recession as many had feared at the end of last year. There had been a kind of renewed hope for a soft landing as we entered this year. But what a difference a week makes, right? Because we went from, it was really an incredible whipsaw moment that, you mentioned I've been doing this for 20 years. I don't know if I've seen this big of a whipsaw. And I guess the 2-year yield reaction tells you I have not, because I was not watching markets in the early 80s. So because that move from basically pricing in a 50 basis point hike in the March meeting and a terminal rate of like 6+% to now basically pricing in maybe a quarter point, maybe a pause, and then the Fed is close to done, is just an extreme repricing for all markets. And it tells you kind of the gravity of the situation, which brings to the second part of your question, which is what's the state of the banking system? I think what the SVB and Signature Bank crises thus far reveal is that I think it's, the financial, not just the banking system, but I think the financial system writ large is potentially a lot more fragile and susceptible to these rate hikes than people had thought. The whole notion that the Fed could just hike aggressively without something quote unquote breaking, it was fanciful, the whole time. And there are these lags in the policy's effects and in the way that people feel interest rate hikes. And now we're starting to see that. And I imagine that SVB will not be the last episode, although I can't predict how severe things are going to get.
Okay. I want to talk about that part, that SVB may not be the last casualty here. But before we get there, let's talk first about, let's separate the banking issues here for a second. So the Fed has been trying to tame inflation, right? As we talked about last time you were on this program. Fed, had a big hand in creating the inflation in the first place, along with Congress, with the twin monetary and fiscal stimulus response to what happened in COVID. The Fed has been pumping the brakes hard, right? I mean, it's increased interest rates by the fastest amount on record in terms of the number of rate hikes in the short period of time that they've happened over. And as you mentioned, it hasn't been manifesting as quickly as the Fed obviously would like, right? That said, we have seen a deterioration in a lot of the macro data. If you look at the government data on jobs, okay, that's a different story. And we can talk, and maybe we will, about sort of how much we actually trust those numbers, because they seem in some ways to be at odds with other private data that's out there in the world. But if you look at the housing market, if you look at retail sales after they're adjusted for inflation, if you look at auto prices, if you look at the manufacturing indices, there's just a whole host of macro data that screams, hey, the economy is slowing down. Some of our biggest and best indicators of recession, like these inverted yield curves, have been screaming, watch out for recession. There's been this kind of, I would say the Fed was already in a tight spot before the banking stuff came around, because it's getting to the point where people have been already clamoring for not a pause, but a pivot before the banking stuff even happened. But the Fed is like, look, I'm not done, right? I mean, I said I got to destroy demand. Inflation's still at 6%. The jobs market, which I've been talking about for a year, that I need to bring back into balance. That gap between job openings and job applicants is still about the same as it was in May of last year. I mean, it's gone pretty much nowhere since the Fed's been doing all of its rate hikes. So just talk for a minute about the quandary there that the Fed is in here, right? Because it as I understand it, and you talk to these guys every day, killing inflation is their number one priority, but more and more people are sort of stacking up against the Fed saying, hey, buddy, you got to stop it. You got to stop it. So where is the Fed's mind here? We've had Powell being really hawkish, but we've got kind of the political world, like I said, kind of increasingly pushing back on him. And the market, until very recently, hasn't been believing him, right? Has been saying, yeah, I know you say you want to hike further and then hold for the rest of the year, but we're pricing in a pivot long before then. So what is the Fed thinking right now in regards to that dilemma?
First of all, the irony is Powell had just finally won the market over in terms of that repricing that he wanted to see, right? The market was finally pricing out the rate cuts. It was finally pricing in a higher peak rate. It was doing all the tightening that Powell wanted. It's funny because I look back at when I came on your show back in October, and I said that the people hoping for a Fed pivot, had another one coming, basically, because you're hoping for something terrible to happen because it's going to be a very high bar. And I think I made the point specifically that it was likely going to be a financial event that did it before an economic event, because the economic slowdown is what the Fed wants to see. What the Fed doesn't want to see is dysfunctional markets where the transmission of monetary policy itself is kind of challenged and compromised, right? And where it has to come up with, and we even talked about this in October, with specialized lending facilities for specific targeted markets and so on. And the chance that they might resort to those in case there was any case of market, any problems of market stress. But the Fed's challenge has just increased dramatically. I mean, the Fed already had a challenge, as you say, to pace, to figure out exactly what the right balance was between not doing enough and doing too much. It had been leaning toward the side of doing a little bit too much, because it's sort of, these particular officials have a mindset of not repeating the mistakes of the Volcker era and not doing start-stop monetary policy and making sure that inflation expectations are indeed well anchored. And they have this sense that the longer that we get these high inflation numbers, the better chance there is for people to start expecting inflation to remain that high, and for wage demands to catch up and create a wage price spiral of the sort that we had in the 70s. So that's been pretty much their top priority, as you mentioned. But Financial stability is another big one, and it's something they don't take lightly at all. So this presents a real challenge as to what to do. I think there's going to be a division within the central bank now between those who think that like it's just incongruous and kind of ridiculous to be to be tightening monetary policy on the one hand while you're easing macroprudential policy on the other. But there is going to be a contingent, especially on the hawkish side, a few people like Chris Waller, who's already made this point kind of preemptively that, hey, if we run into any financial stability trouble, we have the tools to deal with those, and we can keep hiking interest rates separately. It remains to be seen whether that's possible. The Bank of England happened to pull it off, back in October when we last spoke. They were able to halt QT for a period and then return to that market. But if this becomes something more severe, we'll see what happens.
Okay, so you talk to people who work at the Fed, right? What is their level of stress right now? Is there, I guess, do they feel while it's gotten more challenging, they still have the tools and the know-how to get this under control? Whether we believe that or not, do they believe it, or are they beginning to show signs of real anxiety here?
Well, unfortunately, or maybe fortunately for the Fed, this happened during a blackout period where they're not supposed to talk to media at all, at least not about monetary policy, right? But of course, they had an extraordinary action on Sunday night, so they did have to do a formal release of that information, and they did hold a briefing with reporters. And the message from senior officials at the Fed was very much that this new facility is broad and sufficiently calibrated to solve the problem. The question that I had was, what's your plan B? What happens if bank stocks continue to sell off, and if people continue to lack confidence in their deposits? And their answer was basically that we think that this plan will work, because of course, if you reveal your plan B, I imagine that the market would probably test it. So I don't fault them for answering my question that way. But they didn't let on any particular nervousness. But again, it is a blackout period, so it's not like I can call your average economist and just get a sense of what's happening. But I mean, you can sense from how quickly they took action as to how seriously they took it. I mean, just to give you a sense of the gravity, it was basically a bank that most people in the country had maybe not even heard of before was granted a systemic, exemption. It was basically treated like a systemically important institution for a day, and now for at least a year, as they have this open facility. Which again suggests that the banking system is more fragile and the connections are deeper. If people, if something that happens at SVB can have systemic implications, then the threshold is a lot lower than we thought.
Okay, well, I want to, if you can, I'd love for you to just describe for folks in a second what exactly the Fed and the Treasury and the FDIC announced in terms of how they're, staunching the wound, the recent, wound from the failures of several banks, Silicon Valley Bank, Signature Bank, and
Silvergate. We even forgot about Silvergate. Initially, when I saw the Signature Bank headline, I was like, "Wait, didn't that already happen?" But
exactly. I know they all. It's so funny.
They sound alike.
SI are having a terrible week.
I know. So
all right. Well, but before I ask you to do that, real quick, so I'm just trying to make sure the way I'm understanding this is correct. Before the banking instability happened, I sort of look at it as like the Fed is trying to bake a cake, and it's the tools it has to bake the cake are a blowtorch and a freeze ray, right? And it's really just sort of like trying to shoot them, as it can at the cake, and try to engineer this comfortable baking temperature, but it has these two really extreme tools to do it. And so the odds of it getting the cake perfectly baked aren't great to begin with, right? But then with the instability of the banking system, it's almost like you're putting a timer on the Fed saying, hey, you got to bake this cake pretty quickly because guys are coming to shut down the kitchen. I don't know if this is a good analogy or not, but it adds this pressure to what the Fed's trying to do, right? It's like, all right, look, I'm trying to engineer this as soft a landing in inflation as I can, but the system itself seems like it's beginning to become super unstable. And so it forces the Fed, I think, to make a decision, which is, we got to kind of like, really accelerate what we're trying to do here and get this damn cake baked fast, or we got to switch our focus and stabilize the system first. So to me, from what I can tell right now,
let's just freeze the cake and we'll bake it later.
Yeah, well, I guess then that's a great analogy, right? They could just pause, right? They could just say, hey, look, you know what? Things are getting rocky enough that we're just not going to do anything for a while and just stand at the ready. And then if we can resume, great. If we have to rescue, great. Is that what you think they're more likely to do here? Or do you think they're going to try and rush and get this thing cooked as fast as they can before the system, the lights go off in the kitchen?
I think that it really depends on like day to day. Like I think the decision could change for the market's pricing of the Fed decision could change from today to next Tuesday and Wednesday, depending on the market action, right? If there's significant stress at other institutions, you can bet that the market's going to start to price in a pause and the Fed will probably likely pause. If they feel like this is contained, I think they are going to try to sneak in a few more rate hikes. I think there's going to be more. I think the doves have basically won a lot of ammunition for why they should pause. And the whole idea of cumulative lags, which Lael Brainerd first introduced, but now she's not at the board anymore. So it's kind of interesting because there was this hawkish shift with her departure. Mm-hmm. But now it turns out that her camp has the upper hand, whoever is left of her camp. And we don't quite know who the doves are left in the committee. But this is certainly going to embolden some people to want to stop. So I think a debate that was the Fed was already getting into a point of division, because the closer you get to the terminal rate, the more kind of nuanced debate there's going to be about how far to go, which is natural. Right. Now there's even more debate, I think, because there's going to be the sort of the diehard inflation fighters who say, no, this is our mission and we just use macroprudential tools for that. And there's going to be other folks who say, this is, to your point about the dueling tools, this is crazy. This cake looks a mess because it's not working out. Let's rethink. So, but to your other question about what they actually announced, it was all very fast and reporters had more questions than they had answers. But, the basic idea is that they announced, I think the main thing is that they made two things. They made the uninsured depositors for the two institutions whole, but then there's this whole question of like, is this an implicit guarantee to other uninsured depositors and other similarly placed banks, or is it confined to those particular banks? We don't know that yet. And that's, I think, one of the reasons why volatility in the market's going to remain high, is that question remains untested and unanswered and kind of ripe for shorts to kind of test. And so, and the other major thing that they announced is this new lending facility, I guess the bank term funding facility or something like that. I have to look up the acronym again, but there's a lot of them. And that is basically aimed at relieving the kind of funding stress the very specific kind of funding stress that SVB ran into, which is this sort of exposure to normally super safe assets like treasuries, which just happen to be deeply underwater because of the Fed's rate hikes. And they can now be used as collateral, and they can borrow, they can be lent at par at this facility for a year, allowing these firms to basically, at the very least, kick the can down the road on these positions, or potentially to exit them in a safer manner. So those are the two major pieces of the announcement.
Okay. Thanks for describing those. Now let's talk about the potential, repercussions of these. So first off, the backing of the uninsured deposits, is that at 100%? Is that on, dollar for dollar?
100%, which is overwhelming, totally overwhelming to expectations. People were, I interviewed Sheila Bair on Sunday, former FDIC chair. She was talking about, at least 50% recovery, 60 to 80% recovery. But this was just like, no, we got this. And that was aimed at preventing, I think, runs that were already probably happening at some of the other banks where, where similar stuff was taking place.
Okay, so there are two things I want to talk about here, because a lot of people are going to be enraged by this, and we're going to talk about why in just a second. And I'm largely there with them. But to your point, it's not a bailout of the shareholders or the creditors of the bank, right? So the people that backed this bad bank are taking it in the shorts, as they should, right? It's really the depositors. And yes, Silicon Valley Bank in particular, the depositors were really big, VC backed startups. We're going to talk about that in a minute, and people might see this, rightly so, as a bailout of the VCs. But all those companies, and it wasn't just startups, there were a lot of companies. I live in Sonoma County, north of San Francisco, and I learned during this process that all the wineries up here also banked with Silicon Valley Bank. It was like the preferred bank for the wine industry, just like it was for tech. So you had all these rank and file beverage workers, that were freaking out as to whether they were going to get paid, right, when Monday came around. So the point is there were two big costs two big risks that I understand that the authorities were trying to prevent. One, to your point, which is probably the bigger one, right, which is, hey, this is just making all of a sudden every depositor worry about their own bank. And, we could have bank runs, and you could have banks that aren't as bad off as Silicon Valley Bank or Signature Bank. But I mean, any bank, any good bank can be taken down in a bank run if enough people demand their deposits out at once, right? So
especially in a digital era, where, as we saw, like, withdrawals can happen. It doesn't, you can't stand in line for $42 billion, right?
Yeah, exactly.
You can swipe $42 billion out of an account really quickly, right? So it's very.
And you said million, but you meant billion, right?
Billion, billion,
yeah,
absolutely.
Exactly. Yeah.
Sorry about that. Yeah.
So exactly. So part of this was just to sort of say, hey, look, nobody's interest gets served if you have this sort of unneeded panic that brings down a bunch of other banks that otherwise might make it, right? So let's let the dust settle. Let's let emotions cool down. And hopefully avoid that, right? The second thing, as I said earlier, there are a bunch of companies that banked with Silicon Valley Bank. In fact, they had relatively little retail deposits, at least as a percentage of their overall deposits. It was mostly companies. So you had, to my point, you had a bunch of just regular employees who were going to get compromised, maybe, lose their jobs if Silicon Valley Bank just, was left to kind of just croak, right? So I understand the desire to intervene to address both of those things. Then on the flip side of that, like I said, I totally understand the argument that says, hey, look, Silicon Valley Bank ran itself. It had very poor risk management, right? Did some things that in retrospect look really bad. And it and its depositors, I mean, there's a reason why you have deposits that are called uninsured deposits, right? You're supposed to take risk management yourself as a depositor on your shoulders if you're going to keep more than $250,000 in any one account with a bank, right? And that's why corporations have these cash management teams, right, to figure out how to manage all this stuff safely. You're nodding as I'm saying all this, to think about paying them 100 cents on the dollar, I can't think of a really great argument for that. And so is there a way to look at this as anything other than like a bunch of really influential Silicon Valley VCs engineered a clean get out of jail free card here?
I mean, as you say, the moral hazard is kind of really stark. And to your point, there's really no good solutions. It's kind of like, and I had this feeling like, as a professional, I'm just writing about this and reporting on what the Fed's doing, but there's like, as you say, something's like morally dubious about the way the whole thing proceeded, right? All these risks were taken. You could argue that a lot of these firms wouldn't even have existed. Like a lot of the firms that are complaining about the shock that like is now the interest rate shock that is now hurting them would not even have begun to have existed were it not for the other interest rate shock, which was the very low interest rate period that preceded this time. And so the very fact that they're bemoaning this shock is kind of ironic. So yeah, it's kind of hard to see a lot of tech bros bailed out, but there's probably a lot of like, working class wine industry workers that got paid because of this bailout as well, right? And so as you point out, so it's a really kind of difficult thing to swallow, I think, but probably a necessary evil. But it also leaves questions unanswered, like I said, about what happens to other uninsured depositors, and whether does it increase their confidence that they'd be covered, or does it make them feel like, the last money out will be the money that's taxed the most, right? Because do we have enough? I mean, the FDIC deposit fund isn't enough to cover all uninsured deposits, not even close, right? It's like orders of magnitude. So I'm not sure how it's all going to work.
Yeah. Is there any sort of time guidance on when we'll know whether this was just a one-off in this case or not? Or is it just whenever they feel like clarifying, which may be when the next spate of bank failures happens?
Well, the nice thing is that we are going to get data on the usage of this Fed facility on a weekly basis. So we are going to know if there are banks trying to unwind these positions or trying to like cover their Treasury holdings in some way.
Well, let me ask you this.
So that will give us
this, right? Like, I'm not sure, will there be the same stigma that there is for the discount window at the Fed?
That's a totally open question. And I think it's a fear among Fed officials that there will be. I mean, I think they hope there won't be, but there will be a disclosure like a year later. So there's a whole like issue about like, if your name comes up on the list of people who tapped the facility and other people didn't tap the facility, are you the weak link? And so, bank confidence is fragile as you see.
I guess, but let me ask that question again. Like, why would there be a stigma on this, right? If you're running a bank and you're underwater in your money good securities like treasuries, largely because of policies that the Fed itself is enacting, why wouldn't you just say, okay, well, great, make me whole on this right now? Like, I mean, it seems almost like just a smart thing that any good cash manager would do, right? And could that be the unintended consequence here, where it's not a rescue anymore? It just becomes standard business practice that takes risk, perhaps unfairly, off of the shoulders of the banks.
I think it might be an intended consequence in the sense that the Fed would welcome that outcome, in the sense that would mean a large take up on the facility, which would lessen the likelihood of any, similar runs. And so,
yeah, but isn't, I mean, and I meant to ask this question earlier, but now we're deep in the weeds a bit. Like, so is this just socialization of banking risk?
it certainly feels that way. I think there are differing opinions on it. And that's actually one of the top questions that I'm asking, folks who are smarter than me and who are former regulators and current regulators about how they feel about it. But I think there is a big fear about, like, how much of the banking system we are on the hook for ultimately as taxpayers, even if it's not like, I guess there's a big semantic battle about what a bailout is, whether it's a direct subsidy, like, if you don't take out an equity position in the firm, it's not a bailout, I guess. But any kind of taxpayer backing, if you and me could get taxpayer backing to issue some bonds, like some Pedro and Adam backed bonds, we'd do pretty well on them, I'm pretty sure, right? So,
absolutely, yeah.
So there's definitely like some kind of monetary premium on that guarantee, right? So it's a subsidy of some sort.
All right. So look, this is an issue largely of the Fed's own creation, right? They kept interest rates super low for a super long time. That enabled the banks to do all sorts of things in their interests, and then the rise in interest rates here has basically been the opposite, right?
Well, to give you the Fed's perspective, they would argue that they were just reacting to economic conditions of the time, right? There was a period of ultra low inflation in which they felt the need to actually keep interest rates ultra low to meet their statutory 2% inflation target, which they were missing to the downside. And that required even doing extraordinary measures like quantitative easing and all the like. And that, unfortunately, that may have led to a bunch of risk taking on the other side. But from a macro standpoint, they were doing what they could have, it was the sort of best course of least bad course of action for the time. And so I mean,
Okay.
in the latest instance, there's definitely like a mea culpa within the Fed, I think more so than usual in terms of an admission that they moved a little bit too late. I think they would argue
too late in terms of hiking.
Of hiking. Yeah.
Yeah.
I think they have come to that conclusion and they're trying to figure out how they could have done better. There was also a global pandemic and conditions were very, very different from the usual, so a lot of people missed it, but they certainly were slow to react. And I think it's in part because we could argue, there was a whole panel on it at the Booth conference last month that I attended about miscasting inflation, but a lot of it had to do with, them getting stuck on the previous model that I was just talking about, where the big fight. I remember Powell saying like, we would welcome a little bit of inflation. We know how to fight inflation. We just raise rates, right? And now remember when he said that? Like,
I remember hearing you. I remember Yellen saying the same thing. Which is more inflation.
They're not saying that anymore, right?
No, and it's be careful what you wish for. But but kind of back to my point, which is that the Fed basically set the tune that the banks followed, right?
Yeah, no, that's right.
And then the Fed changed the tune, kind of caught a lot of banks off guard here, right? So, but my point is, my bigger point is it's not just the Fed's fault, right? I think the banks are culpable here, and one of the really frustrating things, thinking about the banking system right now, is that they did not raise rates, deposit rates, as the Fed began hiking interest rates. And so, for years, the depositors got nothing. In fact, the deposit rates are still insultingly low at most banks across the country, right? And then the banks were able to get more and more interest on the excess reserves that they parked at the Fed, right? There's trillions of dollars from the banking system as excess reserves at the Fed, earning 4-ish% right now. So they've been making a ton of free money, right? They've had really great conditions, and they didn't in any way, reward the people they're supposed to serve by, basically passing those along to their depositors here. And so there's very little sympathy, I think, for the banking system because of that. And the fact that it has a history of getting bailed out when things go wrong. And so I can understand the ire as people are seeing, hey, there's a full backstop, at least of the big clients of Silicon Valley Bank. And now there's this question being raised, with this new term funding facility, that they might be taking a good chunk of additional risk off banks that will make it easier for these guys to skate and possibly make it easier for them to take risks that they can pay themselves lavish bonuses along the way. And then if things blow up, the Fed's going to step in and make them whole anyways.
There's even the macro question of whether it's going to just loosen financial conditions again and worsen the inflation problem, even in the immediate term, right? They could even do that. If their measures work too well, then, lending will resume as it was before. So I think that's definitely an issue. So I think, as you say, sympathy for the banks. I mean, popular sympathy for banks is not generally widespread, probably, but
this doesn't help.
This doesn't help. It definitely does not.
So I know you're in the business of reporting, right? Where your job is to sort of help us all understand what's going on. And you have a very unique role where you get to talk to the people who are setting policy. And so you have a real front row seat that the rest of us don't have. I don't want to pressure you too much, but in terms of like what should happen in this case, is there any particular different outcome that you would like to see here?
In terms of the Fed's reaction, I mean,
in terms of this reaction to the latest banking woes.
Not in particular. It was interesting. Claudia Sahm, who's a former Fed economist, who has this interesting newsletter that she writes. She argued that she thought the Fed should have kind of suspended the blackout and actually had Powell make public comments like reassuring the financial system strength, and that seemed like a reasonable thing to me, actually. I'm surprised that they didn't try to do something like that. I don't know if there was a fear that bringing him out would cause more panic than than otherwise. I certainly wasn't particularly reassured. Not when Joe Biden came on and said your deposits are safe. I'm like, wait, should I have been worried about them?
Right.
I wasn't worried about them. I
It's like
wasn't
someone
worried.
coming up to you and saying, "Hey, your wife's not cheating on you." What? I wasn't even thinking about that.
Exactly. Nothing to worry about. So I was, yeah, so maybe it's one of those things, right? Just try to keep it under wraps. But I mean, yeah, there's nothing I'd like to, as a reporter, what I want to see is just transparency. I want to understand what's going on and why. I want to understand what regulatory failures led to this. I want to understand what like new regulatory changes this event will potentially lead to. I think there's going to be a lot of political pressure from the Fed on both sides, right? Because of this, because the Fed becomes an easy target. San Francisco Fed was the primary regulator for SVB. By the way, the president was also on its board, right?
I was going to say, can we talk about that? The CEO of Silicon Valley Bank was a director on the board of the San Francisco Fed.
Exactly, and that's because those boards are made up of regional or local banks, and there was that's the biggest regional bank in that particular district, or one of them, and so it made sense, but. Why was the Fed not aware of the kind of shenanigans that were going on? I guess is the question that will be asked.
And that's a great point, which is that a lot of people saw that headline, right, and said, "Oh my God! Well, look, they're in bed with these guys. Of course, they're too cozy and all that stuff, and maybe they are too cozy." But you're saying, no, that's just the way the system works. Right. You have a big regional bank. That guy is likely going to be on the board of the Fed for his region, correct?
That's right. I mean, the Fed operates through the banking system. The Fed kind of is the banking system. So any attempt to divorce them completely would lead to it really is a difficult balancing act, having covered the institution for a long time. You need people who understand market movements and have practical experience. You need people with an academic background. You need people, with a legal background. And that's how the regional banks were set up. They were set up with three classes of directors. One is, local or regional bankers. The other ones are kind of heads of firms in the region, and the third are heads of nonprofits or community organizations. And they're even in charge of picking the presidents themselves. So in a way, the board directors are actually the de facto bosses of the regional Fed presidents. I mean, they're not on a day-to-day basis, but they're the people that make the executive hire. So,
okay,
it's a fascinating design. It's whenever a crisis happens, the Fed's, that comes into question. The Fed's actual structure sometimes comes into question, and that happened during the global financial crisis. So, we'll see if this aspect of the arrangement gets questioned.
Okay. Well, whether we like it or not, I just want to make sure it's clear. That's a feature of the system.
Absolutely.
This was not a bug. This was
this was not a particularly this wasn't some weird nefarious thing. That's just that's exactly how it works. It just so happened that this bank didn't do well in the end, right? So it doesn't look good for them. But
okay. Well,
but just because he's on the board doesn't mean the Fed would have particular supervisory insight into that one bank versus others, right? The Fed just has a role with the larger institutions, which is stress testing very heavily. And with these ones, it's doing a different level of supervision that doesn't involve as much probing. So
yeah, and I think that's what, probably most people that was the dot they were connecting in their head, which is just, hey, because this guy, was so high up at the San Francisco Fed, they probably weren't probing as much as they should. And that may or may not be true, but it is interesting. I mean, there's definitely some big questions. Even the regular folks like us reading about Silicon Valley Bank, you were just like, really? Did nobody dig into this so much? One, their tremendously high percentage of uninsured deposits. Secondly, the fact that apparently they had zero hedges against interest rate risk.
The number of head scratchers, as you say, is there are a lot, right? There's the headline about they had no chief risk officer for the last 9 months of their existence. The list goes on and on. It seemed like it was an accident waiting to happen. So
was this a failure of the regulators, do you think?
I mean, you would think that according to people that I spoke to a former assistant Treasury secretary for regulatory affairs, and Aaron Klein at the Brookings Institution, and he said that he does think that there were regulatory failures, that that there were enough red flags that they should have been seen.
All right.
So
let me ask you a question. I don't know if you know the answer, but it's come up, been posed to me recently, which is, so there were reports that the bank, Silicon Valley Bank, was generous with bonuses. One, I heard that there were a bunch of staff bonuses that were paid, I mean, I don't know, like maybe hours before the bank got shut down. So that makes people think, oh, there was a sense of like, let's get as much out as we can right before we're shut down. And if you have anything to say about that, great. But the other thing that I saw was, fairly big equity withdrawals being taken out by a lot of senior executives in the months leading up to last week. Is there the potential that some of that stuff could get clawed back, and or prosecutions of the executives at the top who are running the bank?
I don't know enough from a legal perspective, but I saw the same stories that you're talking about, and they were from legitimate sources, and it doesn't look good at all. That's the part that makes it look nefarious, actually, is those withdrawals, right? The fact that they apparently knew something was going awry, and they were taking money out, which in fact contributed to the run on themselves, right? Apparently. So yes. If that's the case, I'm not sure. It doesn't seem legal to me, but I'm not a lawyer.
Okay. All right. Well, look, if you have any updates to that in the future, if you hear anything before we do, let me know, because I know that's a question that a lot of folks have been, asking is like, hey, are these guys going to potentially get to skate, right?
I'm not a lawyer, but I can definitely get one on the phone, so I'll ask one.
Great.
I'll ask a smart lawyer, and I'll get back to you. All
right. So, folks, if Pedro does get anything interesting on that, we'll record a quick 2-minute download, and I'll put that back up on the channel here in a bit. All right, Pedro. So let's assume / hope that the banking system kind of holds together from here, right, and that things subside. The Fed still has the challenge of, okay, I gotta bring inflation under control and try not to have a hard landing. I've had a lot of people on this program, and honestly, almost all of them, and they're not selected for this reason, but I've this way. I've had very few people say, oh, I think a soft landing is actually engineering, is possible here, or probable. I don't know if I've talked to anyone who thinks it's probable, except maybe for Tom Lee, who is known as being a super bull. But there was a case being made, and I'll include myself in the people making it before these recent banking issues, that the Fed may very well be over tightening at this point. And I think the honest answer is we just don't know. But a lot of people, myself included, just doesn't think our highly leveraged economy can run on interest rates this high, on the cost of debt this high. And of course, the Fed is still saying it's going to take it higher. So I guess first question for you is, what are you seeing in the debate of continue hiking versus pause? Let's take the pivoters off the table for a second, but just continue or pause. How is that debate being waged right now?
Yeah, it's very interesting, because the Fed was very reluctant to talk about the Taylor rule when rates were like at 2%, and the Taylor rule suggested they should be at like 9%, right? Mm-hmm. But increasingly, the outsiders, like the former policymakers who were like, hey, you should have at least some kind of Taylor rule discussion so that we can have a parameter for where you're headed, like so we can understand your reaction function. They started to win the day, and their whole logic about like how you needed to bring the interest rate, you need to make real interest rates positive by about 1% or about 1.5%. Kind of started to win ground, and actual Fed officials started to talk in that same language that previously only the former Fed officials were speaking to me in. And so I think at least until these financial stability concerns emerged, the issue was very much about like, when does the Fed funds rate cross the CPI, which it's about to kind of do, and then we can settle at that level, and then we'll be restrictive for a while, and we can gauge by how fast it falls how soon we can cut later on, maybe next year, right? That was the hope. Now it makes it very hard to predict, because the financial stability thing is just going to make this a very, a huge ping pong game. Imagine how little people actually cared about the CPI even this morning compared to how much it was being built up. It's going to be very difficult. But I imagine that argument will continue internally. There's also the issue that the Fed is very concerned about two things: inflation persistence and inflation breadth. So like Fed officials, especially at the Atlanta Fed, Raphael Bostic and his economists, they focus on the number of items in the CPI basket that's growing over X figure. Sometimes it's 6%, sometimes it's 5%. I think that the 6% one peaked at like 3/4, like in the summer, but it was still at like half of the items are growing over 6%. I don't know what it is for today's report.
Oh, okay.
So this is as of the last report. And so that's a bad sign for them. Like, I think pre-crisis, it was something like 10 to 20. And so that's a big thing for them. Like, that's something that they worry about a lot, because again,
it's pretty broad inflation.
Yeah, it's broad, and it shows that it's kind of system wide. The huge uncertainty that this financial event inserts is that, like, credit crunches, which this might, financial event could lead to a credit crunch. That's the fear. Credit crunches are like deeply disinflationary. So if you are correct, if your view that like this economy can't sustain this level of rates for very long is correct, then we could get like a very rapid disinflationary spiral down the line. And I think that's what you've been alerting us of and been concerned about. So that could definitely happen, especially if it's driven by kind of financial ripples from this crisis.
Well, let's talk about that for just a second, because I don't think we talked about this issue when you were on last, if I'm remembering correctly. But as you know, a Fed policy acts with a lag, a pretty substantial, right? And so in the weekly market recap I recorded this past weekend with Lance Roberts, he made a comment which I completely agree with, where he says the failure of Silicon Valley Bank and Signature Bank that's a casualty. That's one of the early casualties of the lag effect of these Fed policy increases, right? I mean, it literally got flat-footed by the change in interest rates that the Fed engineered, and it's now we're learning one of the weaker players, and it died as a result of its vulnerability. And so we may just now be beginning to really feel the impact of the first hikes that the Fed did starting a year ago, right? There are a whole bunch more hikes, some of them pretty darn big, several 75 basis point hikes in there. And those shockwaves are still traveling through time, and they're going to be slamming into the economy again and again and again over the coming quarters here. How concerned should we be about that? Because humans being humans just sort of think, oh, well, the Fed pulled a lever a year ago and we're still here, so we're fine, right? They don't realize the impact of that is still traveling through time towards us.
I think that's a really important point. Since you like analogies, Nick Timros had a really good one in the Journal the other day, which is like tapping a bottle of ketchup, and at first nothing comes out, and all of a sudden, like, it just, your meal is ruined by a bucket of ketchup.
That's a great
Isn't
example.
that perfect? And so
that.
Yeah, so that's a really good one, and that's kind of where we are. But you don't know how much is going to spill when, right? So I think, to your point, yeah, if you add that lagged effect to the existing stress, that could be a very, perilous combination. And I think, I think this is just the first of many episodes. I hate to be like, I'm not fear mongering, but this kind of crisis doesn't just go away in a flash, right?
I think I'm afraid to admit I think you're right here, right? I mean, I'd love to say, we don't need to worry about this, but I think it's a very real risk. I
mean, when I came here in October, we were talking about LDI, and I said, like, I don't think this is the last thing. And the LDI was actually, to me, the first casualty of the rate cycle, right?
Can you just very quickly explain LDI for folks that don't recognize the acronym?
Sure. I don't even know what the acronym stands for. Is it long duration? I don't even know. But what it actually was just a pension crisis in the UK, which was brought about like by a terrible budget that they released that was, that had unfunded tax cuts and the like, but also very importantly by the sharp rise in interest rates that left the pension funds asset liability mismatches that just deepened them to the point of crisis, basically. And the Bank of England had to step in and intervene. I think that was the first financial ruction, even though it didn't happen domestically. It was still kind of Fed induced broadly speaking, because while the Bank of England is tightening, there's no tightening like Fed tightening, right? It's the
Right.
Fed decisions that affect global markets in that big way more than any other central bank. So,
and that's another great point, which we don't really have time to get into here, but is when we feel a shockwave from Fed policy, oftentimes the rest of the world feels that shockwave to a magnified extent, right? And so there may be some very important breakages that happen offshore that then come back to trigger more problems here.
Absolutely. I was just talking to some traders in South Africa about the SVB crisis earlier today, and they made that exact point that every wave here is a tsunami over there. So
yeah, and I haven't looked at it today. And the banking stocks are rallying the day that we're talking here, Pedro. But I know that Credit Suisse, which the world has been looking at, with increasing skepticism over the past quarters, was like really falling into worrisome territory yesterday. And they've seen record deposit outflows, and their, default
credit default swaps
going through the roof. Yeah, their swaps are going through the roof. So, again, the worries here could bring down a big player like that. And of course, that's going to create ripple effects in Europe for sure.
Yeah, the fact that these headlines are happening simultaneously, and the fact that actually I've seen a lot of headlines from countries that you wouldn't even think about, like startups, in China that had funding from SVB. Like the ripples are fairly large, and they take time to be assessed. And so, this is the 16th largest bank in the country. So it wasn't a SIFI per se, but it kind of was, right?
Yeah.
So
hey, and I'm sorry, I should have asked this earlier, but so are you clear on what is happening with SVB right now? Like, is it going to get bought? Or is it just going to get
I think they would still love to have a white knight buyer. I think the real effort was to find a buyer over the weekend and make the announcement. Like the Fed wishes that the Sunday night announcement was JP Morgan has purchased SVB and is guaranteeing, but that wasn't the outcome clearly. And so I think they're probably now going to try to what happens to it is that the FD, we own it, right? The taxpayer controls it. They have new management there. I think it's a former Fannie guy who's in there, which
it is. I don't remember his name, but yeah, he's a former
also
Fannie
part
guy.
of the circular irony of banking and crises.
Sorry to interrupt you again, but yeah, I'm going to get this wrong, but there was a guy. It wasn't for Silicon Valley Bank. It was for Silicon Valley Securities, which was one of their subsidiaries. Who I want to say he was risk manager at Lehman.
I saw that one as well. Yeah. I know.
So to your point about the circularity of this, right?
I know. No, the ties are never ending. So,
all right. Well, look, as we begin to wrap this up, Pedro. So, the people watching this video are regular people, trying to sort of understand what's going on and wrap their brains around it. You've done a very good job. Thank you of helping us, see things more clearly here. When you sort of look ahead in terms of, what you expect to come out of all of this that we've talked about, let me put it this way, people watching here are trying to just say, hey, I'm trying to understand what's happening at the policy level, because I don't want to get wiped out by either bad policy decisions or just the ripple effects of whatever policy decision gets made here. I guess maybe first question for you is do you expect the volatility of the impacts from policy decisions to increase, decrease, or sort of stay the same in this environment we're heading into?
I think it's going to.
Our interview with Pedro will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. And don't forget that Wealthion's online conference is now just 2 days away. Register now for Saturday's event at wealthion.com/conference. And finally, if the challenges to Fed policy that Pedro has detailed in this interview have you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no-strings-attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends, risks, and opportunities that Pedro has mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Pedro de Costa.